Okay, good morning and welcome back everyone to our Tuesday morning market outlook session. My name is Tony Zhang. I'm the chief strategist here at Options Play. And today we're going to be taking a look at global equity markets, where we currently sit, and some of the movements we're starting to see from not only equity markets here, but overseas, and the opportunities that we see in the morning in the markets. So before we get started, what we're going to discuss here today is purely for education and demonstration purposes. It is not a solicitation or recommendation to buy or sell any specific securities. So we'll start, as we normally do, with our broader market update here. Let me just get my pointer. We're going to start off with our market update here, just to see where the broader equity markets currently sit. We see a bit of negative divergence here, some signs of exhaustion, so we want to point that out across the major indices. As far as the sectors, we're starting to see some of the weaker sectors rotate into some of the weaker sectors like staples and industrials. We want to show you some of those charts. Rates continue to move in one direction. Fixed income traders are continuing to sell riskless assets, less risky assets, and buying riskier assets, providing a bit of a vote of confidence, I think, for equity investors to continue to take on risk here. But that also has some ramifications here on commodities, so we'll take a look at that. And then on the economic side, we'll take a look at some high-frequency mobility data. We'll also take a look at what 2021 GDP estimates look like. They're actually fairly strong. How do they distribute across the year, to give us a better sense of where we expect some of the highest growth here in 2021, and then share with you a few ideas before we open this up here for Q&A here at the very end. But the primary thing I want to help investors walk away from here today is actually thinking a little bit through the new stimulus deal that is trying to be passed by President Biden and his administration. There are certain concerns from some investors that this is actually going to start to overheat the economy, that the tax burdens is actually going to be too large. So there's certainly a Republican pushback here on the size of the stimulus that's providing a little bit of a, I would say, feedback for the equity markets right now in terms of their response to further stimulus, especially after last Friday's job number that wasn't particularly strong, providing some evidence that there is still need for stimulus, but the question is how much. So my name is Tony Zhang. I'm the chief strategist here at Options Play. And what I want to share with you are my charts, my technical research, our economic research, to inform our decisions as to how we position here in the broader markets. So we'll start off here with the S&P 500. Now, over the past couple of trading sessions, the S&P 500, after taking what was a pretty sizable correction to the downside, considering we've had basically 3 months of nothing but just a slow grind higher, it quickly bounced higher here to new all-time highs, and over the past couple of trading sessions, continue to put in new all-time highs yesterday. So as you can see here, over the past few months, what we have continued to see are these slow moves here to the upside. But as you can see, if we look at the momentum indicators, they started to diverge away from these new higher highs. So momentum is no longer confirming these new highs, and we're seeing it both on the daily and weekly charts as well. As the weekly chart continues to make new highs, momentum no longer confirming those highs. And during that time, as you can see, money flow starting to weaken here. So this is some of the warning signs that we're starting to see here in the broader equity markets. We saw the same type of warning signals back in January and February of last year, going into 2020. We saw the same type of negative divergence from weekly and monthly indicators. Now, obviously, that could not have possibly predicted the pandemic, but these are just similar market conditions that we're starting to see from the broader equity markets that are seeing this negative divergence. And that, for me, informs my views of being cautiously bullish going into these markets. Now, there's certainly going to still be opportunities when you look at the specific sector rotation. The S&P 500 is still, at the end of the day, a very broad index. There are a lot of constituents, some very strong, some very weak. The goal here is to try to find stocks that are rotating within that sector. So when we look at the Nasdaq 100 index, same thing. after a correction here or last 2 weeks ago, bounced back, made new all-time highs, but again, negative divergence here on the momentum indicators, both on the daily and weekly chart as we make higher highs on price, but momentum indicators no longer confirming those views. And as you can see, also money flow here on the Nasdaq 100 starting to slow down here, almost turning negative here. So this is concerning to us, but it's not a reason to short the markets. This is a reason to start lightening up on your long positions. This is a reason to start generating income by selling cover calls, cash, credit spreads, these types of strategies that allow you to collect premium, especially when volatility is still relatively high here, and potentially use that income to buy puts if the markets start to correct lower here. Now, at the moment, I don't see a strong catalyst as to what's going to drive the market significantly lower, but you certainly could have some positioning, some profit taking that drags the markets a little lower here, and trying to protect yourself using puts, you would use some premium from the cover calls to go about doing so. If you look at small caps really exploded here over the past couple of days, well beyond its all-time highs here on around 215 here on IWM. As you can see, strong relative strength here for small caps, a very small, I would say, let's just call it a very small consolidation range that we saw here and a breakout here. So this certainly projects out quite a bit higher here for small caps, but same thing, negative divergence as you make higher highs, no longer confirming that. But I will say on the weekly chart, so far, we're still seeing mostly a little bit of negative divergence here on the weekly chart, and the weekly chart, both the daily and weekly chart, currently overbought. So small caps showing a lot of strength, but seemingly quite exhausted and overbought here. And lastly, if we look at RSP, the equal weight S&P 500 index, also finally confirming new higher highs. So playing a bit of a catch up here because RSP, the equal weight index, falling behind, not making new all-time highs while the S&P was, showing us that the leadership in the S&P 500 was narrowing, but we're starting to see this broaden out again here. So this is generally speaking constructive of the upside move that we're starting to see here from equities, because you want a broad participation. When you have broad participation, that is the sign of a healthy market. Also, when you have strong sector rotation, that also is the sign of a healthy market rally. When you have just one or two major sectors dragging the markets higher, that is generally what we consider not a very healthy market rally, which is largely what we saw back in January, February of 2020, where it was dominated by technology and consumer discretionary, and all the other sectors were falling behind. Here, it's sort of the opposite. We're seeing a fair amount of sector rotation. We're going to take a look at some of that sector rotation here in a second. But the value versus growth argument or trying to decide, well, which one is going to win, right now we're still in that debating phase, if you will. So value has underperformed growth for a long period of time. And what we have been doing over the past 6 months or so, a little longer than 6 months now, has been in this consolidation range. Now, for those of you that are technical analysts, you might notice a formation that looks like what we call an inverted head and shoulders here. And what you have is a potential breakout here that would reverse value's underperformance. But so far, that has not happened. So from my perspective, this is still just a consolidation range. And the question for consolidation ranges is always, it can resolve itself one of two ways. It can resolve itself this way, which certainly would put value back on the map. However, so far we have not seen that breakout. What we could also see is this range bound basically become a continuation pattern here for the underperformance here for value, and for value to continue to underperform. Now, we're still in this debating phase. This could happen. This could continue on for weeks. It could continue on for months. But for now, value is keeping pace with growth. One is not outpacing or outperforming the other here. So we don't have a strong catalyst for positioning stronger towards value or stronger towards growth here at the moment. We're still cautiously bullish, But so when we look at where do we, position, that's really when we have to look at sector rotation. So XLP Consumer Staples has been underperforming here for the better part of a month here, pretty much since, as you can see here, you've got this double top here at 68, which happened just before January 2021. While the equity markets have been rising since then, XLP has been declining, so losing relative strength here. And what we have here is a nice channel here. And what we're looking at is a potential breakout here above this channel and starting to rotate into consumer staples. We've seen some strength out of the names, the big names within XLP like Coca-Cola, Pepsi. We're seeing rotation into some of those names. So that could be a precursor here for some rotation into what was a weaker sector here over the past couple of months. The other one that I want to point out here was Xli Industrials. Industrials also really falling a bit apart here last week. While equity markets were declining, Xli now also finding a little bit of its legs and finding a little bit of strength here. Basically, what we have is a strong rally, a long consolidation period, and now a potential breakout here, which would project up to close to about $100 here in Xli. So this is another pattern that we're paying attention to. It hasn't broken out yet, so we're going to be a little patient here and look for this breakout, but we're just on the verge of what looks like a triple breakout here above $90. I would look for a close above 90, potentially retest this level also before it continues to move higher here. So XLI, another one that has been lagging behind. We're starting to see some rotation into those sectors. So, shifting our focus here a little bit towards commodities here. So gold has been an underperformer here for a period of time here. As you can see, we have a pretty clear, well-defined channel here. Bottom of the channel, whenever it reaches near the bottom of the channel, it gets rejected, and that's largely what we've received here. And you can draw this a few different ways. I usually prefer to draw horizontal lines. I find that horizontal lines are less subjective. So when you look at this double bottom here that we've seen here around 167, that certainly points to a bit of support here for GLD. Now you can have the same version of this on SLV, but also other precious metals like platinum and palladium are starting to break out higher here. I'm going to show you some of the other charts here that support commodities to actually start to rally here. So gold is certainly one that's on my radar. I certainly think that we would first target the top of this range here as a starting point and see if gold can finally break out here. It's made multiple attempts to break this line, as you can see. Tried to break out here, failed. Tried to break out here, also failed. And the question is whether it can now find the strength here to break out here, especially with a weaker dollar. That certainly provides further support here for a breakout here on gold. When we look at the U.S. Treasuries here, so we've been following the 10-year yield for quite some time. We had that strong move from that 90 basis points all the way up to 115. That's what sparked the rally we've seen in banks, in financial firms, the pullback here, and now we've come back to retest this 115. And the question is whether Treasuries can break out above this 115 or not, or this becomes more of a range-bound play between 110, 115. Now, just from the perspective of the fact that the Fed has been pretty clear since the start of the pandemic that they will continue to buy treasuries, and they will likely move their purchases further out into the curve towards the 5 and 10 year. I think that's going to put an artificial cap, in my opinion, as to how much higher these 10-year bonds can move in terms of yields. I think that artificially you have a cap around this 115 level. You could see a breakout here, but my view is that this kind of becomes more range bound around this 110, 115 level. This might put a bit of a cap here on XLF. XLF, one of the strongest sectors, both XLF and XLE, energy and financials, two of the strongest sectors at the moment, starting to see a bit of a slowdown here, starting to see their leadership slow down as we were seeing staples and industrials start to see a little bit of strength here. So, looking at treasury yields, as it stays around this 115 level, it's going to put a bit of a cap here on some of the financial firms. Now, when we look at treasuries, this is really where it becomes still a one-way trade. If you look at TLT, longer-term bonds, one-way trade. A very strong sell-off in treasuries, or outflows rather, in treasuries over the past 6 months or so. And when you invert that to HYG, which is high yield yesterday made a new all-time high. So we're still continuing to see inflows into higher yielding fixed income products and out of treasuries, meaning fixed income investors are putting on what we consider a risk on trade, selling treasuries, buying higher yield, riskier fixed incomes. This is a bit of a vote of confidence to just the shape of the economy and the recovery of the economy. You would usually buy these types of products when you feel confident in the environment of the credit markets, and then you would sell HYG and buy treasuries when you have no confidence. So right now, fixed income investors sending a pretty clear signal that they are very much in this risk on environment. And lastly, I want to take a look at dollar index. So, we talked about the dollar index looking like they were starting to bottom here, right? Putting in what looked like a head and shoulders formation that was going to stop this debt decline. Inverted head and shoulders pattern started to break through the neckline here, and it looks like it's failing that breakout here. Now, I noticed the same pattern here. We had the same head and shoulders pattern here where you had a strong downtrend, looked like it was bottoming, came out and broke out the neckline, and then finally just continued its decline. So this ended up not being an inverted head and shoulders pattern. It just ended up being a more of a let's just call it more of a consolidation range, a longer consolidation range before it continued moving higher here. And it looks like we're starting to form another one similar to that. Now, this is the question as to whether the dollar will continue to weaken, or it will strengthen because the economic recovery is starting to take shape here in the United States. So that's what we're currently watching here. But the head and shoulders pattern, the inverted head and shoulders pattern that we're looking for, that breakout of the USD becoming stronger, so far having failed. And then when we look at a weaker dollar, a potentially weaker dollar, or at least a dollar that's no longer strengthening, this really puts, again, commodities back on the table, because if dollar isn't strengthening, that's not going to put a drag on commodities. And it's also going to be a net beneficiary of emerging markets, because a lot of emerging market companies have debt denominated in USD. And when USD gets weaker, it's able to repay its debts quicker. So when we look at EEM is on the verge of a fairly sizable breakout here above $56. So this is one that I'm paying attention to, a potential double top breakout formation here for EEM. And I've talked about EEM quite a bit from the perspective of the exposure that you're getting from this ETF. About 2/3 of this is exposed to China, Taiwan, Japan, and South Korea. Places that have COVID largely under control and have lives returning pretty much back to normal and business as usual. Restaurants are full, bars are full, people are out and about. When you have that type of economic recovery, that's going to be stronger than, let's say, domestic equities that currently still have fairly limited lockdowns across the entire country. And then you look at the exposure that you get from a sector perspective: technology, consumer discretionary. Those are the two main sectors here in EEM, which are strong sectors that we expect as part of this economic recovery to do well. So for those reasons, I'm looking at EEM for a potential breakout here. And then when we take a look at some of the economic indicators, this is U.S. economic indicators. When we look at high frequency mobility data, we're starting to see some encouraging trends emerge here over the past 4 weeks or so. High frequency mobility data, after trending lower here for multiple months since September, has started to see a fairly significant uptick here to the upside. And then when we look at job postings here in the US, we finally just got back to pre-pandemic levels in terms of changes in job postings since February 1st of 2020, actually higher than what we have seen here since the same time last year. So these are all encouraging high-frequency data that gives us some confidence in the shape of the economic recovery, or at least, in terms of hitting a bit of an inflection point here with respect to the second wave that we have seen that has caused a pretty significant downturn in the shape of the economic recovery. And then when we look a little bit out towards 2021 and 2022, and we look at, what are our estimates here for GDP right now? If we look at Bank of America estimates for 2021, their old estimate was about 5% growth year over year in terms of GDP. Their new estimate is now 6%, so revised higher. And for 2022, their old estimate was 3%. They've now increased that up to 4.5%. So we've seen a fairly significant uptick in terms of their economic forecast here, and this also is updated because we have new information, we have better information, so we have better estimates here. But what's really encouraging here is for Q2 and Q3, they've seen some pretty significant upticks in terms of their economic forecast. So Q2 revised up from 5% to 7.5%, and then Q3 revised up from 5% to 10%. So this is really where we expect to see some fairly significant acceleration in terms of economic growth here. And this is Suntrust. Suntrust is now, somewhere just in between the old and the new for Bank of America, looking at about 5.5% here for 2021. So that's again forecast here going, and this is one of the strongest that we have seen, 5.5% up, 5.5% per year, 6% per year. That's some of the strongest GDP growth we have seen since the post-World War II. So these are strong forecasts, and this is part of why there are some concerns right now as to whether the current stimulus, the $1.9 trillion stimulus plan that President Biden has proposed, is some investors and some not only investors, but also parts of the government that have been doing research in terms of the economic impact of a $1.9 trillion plan, is really concerned that it might overheat the economy, that we might start to see some real inflation in the markets as a result of another $1.9 trillion flowing through the economy. What that's going to do to the deficit, that would cause us to have the largest deficit since World War II. So, and the question is, do we still need it? If we're expecting this type of growth right now without that stimulus, do we need another $1.9 trillion in the form of just handing out money? So there's certainly some debate here from markets as to the necessity of that and how much of it do we need. I think there's certainly there's plenty of sectors and industries that still need stimulus, but a broad-based stimulus across the board is probably what investors are debating here at the moment. So when we look at some ideas here, the first one I want to point us here to is Schwab. Now, Schwab recently, as you can see, made a pretty sizable breakout here above this $50 range, which was the all-time highs from November of 2019. We recently had the breakout here and a very strong move here to the upside from 50 all the way to 62, came all the way back to retest this level as support on the weekly chart, and is now starting to resume its bullish trend here. And if we zoom in here on the daily chart here, this is just to give you a quick look here of the breakout here. You had a small breakout here, a quick a slow breakout here. It wasn't a particularly fast one, and then a big move here to the upside. This was after we have seen the rates continue to expand here in the U.S., came back all the way down to this level of around $50 or so, and has now finally gotten back above the 21-day moving average. So as you can see, the 21-day moving average largely has provided a lot of support here. So the fact that we've managed to get back above the 21-day moving average is the opportunity that I see here. Now, the reason that I'm looking at Schwab here is because I see that there's still about $7, $8 of upside here from a risk to reward perspective, and you're less than about $1 above the 21-day moving average. So if you fall back below the 21-day moving average, then I would cut my losses here, looking at about $7 to $8 here of upside here in a name like Schwab. So that's the first idea I wanted to share with you. And the next one I wanted to take a look at is MRO, Marathon Oil. Now, I don't talk about oil stocks very often, especially because, I'm a true believer in the shift that we've seen away from fossil fuels towards renewable energy. That trend has started. That trend is clear to us But oil continues to rally here on the lack of supply over the past few weeks, and we've seen energy continue to dominate as the #1 strongest sector here. And I want to point us towards Marathon Oil, which has made multiple breakouts here. First above $77.30, came all the way back to retest this level, and is now breaking above this $8.50 double top here. So looking like it has a lot more potential, especially if you look at the weekly chart. You have this $8.50 major resistance level since the start of the pandemic. Finally breaking out here, this would certainly project up to potentially $11 or so here to the downside, to the upside, which was the last prior support that we here that we have here on this particular stock, which is held for quite some time throughout 2019. So Marathon Oil, as we look to energy continue to see some strength from crude, energy remains the top sector here. And lastly, looking at Nvidia. Nvidia having been range bound here for a long period of time, a very narrow range too, finally breaking out here to the upside with some strong momentum, and hasn't broken the total range here, which was put in here on the September 2nd highs, but it is testing that. So this is one that I'm going to watch today. A breakout higher here would certainly project substantially stronger moves here to the upside. As you can see, Nvidia, a long, I would say, consolidation range that we have seen here after a big move here to the upside from 175 or so all the way into the 500s. You had this long consolidation range, and the question is whether this is the breakout that puts Nvidia significantly higher here. So this is one worth paying attention to. So with that, that covers what I wanted to share with you here today. I hope that this was helpful in giving you a better understanding as to how we're looking at the broader markets, how we're seeing the sector rotation play out here in the broader markets, and provides you with some insights into some opportunities. With that, thank you so much. I hope you guys have a great trading day, and I'll see you guys here next week.